Have you ever successfully sold an investment, property, or another valuable asset, and then wondered about the next step for your taxes? Understanding how to properly report those gains can feel like navigating a complex maze. When it comes to reporting capital gains for your taxes, you will primarily use a specific set of forms. Your capital gains and losses are first detailed on Form 8949, Sales and Other Dispositions of Capital Assets, and then summarized on Schedule D, Capital Gains and Losses, which is then attached to your main tax return, Form 1040. The fundamental reason for these separate forms and calculations lies in how capital gains are defined and taxed. A capital gain is essentially the profit you make when you sell an asset for more than you paid for it. The Internal Revenue Service, or IRS, distinguishes between two main types, short-term and long-term. Short-term gains come from assets held for 1 year or less, and they are typically taxed at your ordinary income tax rate. Long-term gains, from assets held for more than 1 year, generally qualify for more favorable, lower tax rates. This distinction is critical because it significantly impacts your tax liability, encouraging longer-term investments. To properly report your gains, you will need to gather essential documentation. This includes statements from your brokerage firm or financial institution, often provided on Form 1099B, proceeds from broker and barter exchange transactions. This form details the sale price of your assets and the date of sale. You will also need to know your original purchase price, or basis, and the date you acquired the asset. With this information, you can calculate your net gain or loss for each transaction, inputting these details onto Form 8949 before they are aggregated onto Schedule D. An interesting detail to remember is that capital losses can actually offset capital gains, and even a limited amount of ordinary income. If your capital losses exceed your capital gains by more than $3,000 in a given year, you can carry forward the unused portion of those losses to future tax years. This powerful strategy, known as a capital loss carryover, can reduce your taxable income in subsequent years, offering a practical way to mitigate future tax obligations. By diligently tracking your asset purchases and sales, and understanding the difference between short-term and long-term gains, you empower yourself to accurately report your investment profits. This proactive approach helps you take advantage of potential tax benefits like loss offsetting and ensures you meet your tax obligations efficiently, ultimately building a stronger financial foundation for your family.